Welcome to Sophie Daddy's channel. Today, we're tackling a question that's at the very heart of any day trading strategy. How in the world do you get an edge before the opening bell even rings? We're going to break down the chaos of the pre-market.
You see, this isn't just about watching a stock tick up or down. It's really about decoding a whole set of complex signals in a pretty unique environment to try and figure out what's going to happen when the floodgates open at 9:30 a.m. sharp.
The pre-market is where the battle lines for the trading day are really drawn. It's this chaotic landscape of low volume, huge swings, and absolutely crucial information. Now, if you're unprepared, it is treacherous. But for a disciplined trader, it's a field just packed with opportunity.
Okay, so to find those opportunities, you first have to understand the inherent challenge of this whole environment. And the biggest problem in the pre-market, hands down, is figuring out what's a real signal versus what's just random noise.
So, first off, what is it exactly? Well, unlike the regular session with its big, centralized exchanges, the pre-market works on this kind of fragmented web of electronic communication networks, or ECNs. And listen, that's not just some boring technical detail. This structural difference changes absolutely everything about how prices move.
And when you actually compare the two sessions side by side, the differences are just stark. In the pre-market, liquidity is incredibly low. We're talking only about 6% of the total daily volume. This makes those bid-ask spreads get super wide, which makes every single trade more expensive. And that combo, low volume and wide spreads, it creates an environment of insanely high volatility.
And all of this really boils down to one core idea: the signal-to-noise ratio. You see, a massive price jump in the pre-market could be a genuine signal, a real shift in that stock's value. Or it could just be noise, an exaggerated blip caused by one or two trades in a super thin market. The entire game is learning how to tell the difference.
So, if the pre-market is so noisy, how can you possibly find a reliable direction? Well, you need a compass. And that compass is built on understanding that not all pre-market information is created equal. There's a really clear hierarchy.
This breaks it down perfectly. Right at the very top, your most reliable signal is index futures. Below that, you've got the performance of global markets, which of course heavily influences those futures. Then comes the news catalyst, the why behind a move. And way down at the bottom, the least reliable signal all on its own is the price action of an individual stock.
Let's just zero in on the top of that pyramid for a second. Index futures, especially the E-mini S&P 500, are your true north as a trader. Why? Because they trade almost continuously, 24/7, and they have way more liquidity than individual stocks in the pre-market. Their price is just a much more solid and trustworthy reflection of what the market is actually thinking.
Now this quote, this is a total game changer in how you should think about the market open. The gap you see on a stock chart, it's not a surprise. It's an illusion. The price has been adjusting all night in the futures market. The opening bell is just the moment the regular stock market is finally allowed to catch up to where the futures already are.
Okay, so futures give us the likely direction for the whole market. Now it's time to apply that to an individual stock's gap. Because seeing a price jump is one thing. Knowing what to do with it, that's the real challenge.
This right here is the million-dollar question every single morning. A stock is up big. So, do you jump on board, hoping it'll run even higher? Or do you bet against it, expecting that initial pop to just fizzle out? The answer isn't a guess, it's about reading the signs. And here's the key, and this is so important. The price move itself is actually the least important piece of information. The real answer is in two other variables. First, how strong is the news that's causing the move? Is it a game-changing earnings report or just some flimsy rumor? And second, what's the pre-market volume look like? High volume shows conviction, low volume shows weakness.
And this is where things get really fascinating. Get this. Academic studies on market gaps have found this really clear pattern. When bad news hits, the market prices it in pretty much instantly and completely. A gap down is often the new fair price, right at the open. But good news, the market takes its time digesting that. And that means stocks that gap up on good news have a statistical tendency to keep drifting higher through the day. Okay, so knowing this gives you a huge edge. It helps you build a framework for the two basic choices you have when you see a gap. You either follow the momentum or you fade the move and bet on a reversal.
So let's imagine a stock gaps up. On one hand, you have the gap and go strategy, where you're betting that initial strength is going to continue. On the other hand, you've got the fade the gap strategy, which means you're shorting the stock, betting it's going to fall back down. The decision of which one to choose depends entirely on the evidence. So when should you follow that momentum? Well, you're looking for a perfect storm. A powerful, undeniable news story, like a massive earnings beat. Exceptionally high pre-market volume, showing the big institutions are buying. A technical setup where the gap is breaking out from a solid base. And finally, the overall market, guided by those index futures, is also strong.
And when is it better to fade the move? The conditions are the exact opposite. The catalyst is weak, maybe it's just a rumor, the pre-market volume is super light, suggesting there's no real conviction, the stock is gapping right up into a major resistance level on the chart, and crucially, the broader market is weak or flat, so there's no tailwind to help it out.
Look, all of these concepts are powerful, but they're pretty useless without a process. The real key to trading the open isn't some secret indicator, it's a disciplined, repeatable checklist that you run through every single morning.
So here's a simplified version of that process. You start broad, you assess the global market tone. Then you zoom in on your most important signal, the index futures. Next, you find the key news that's driving the day. And only then do you start scanning for individual stocks that are gapping. And finally, you build a specific trade plan for the best one.
And that last step, it's completely non-negotiable. The first 15 minutes of the open are pure chaos. If you don't have a precise plan for your entry, your exit if you're wrong, and your target if you're right, you're not trading, you're gambling. You have to define this plan in the calm before the storm. And that plan has to include specific risk management rules for this crazy environment. Wide spreads mean you always use limit orders, never market orders. High volatility means you use smaller position sizes and wider stops. And for most strategies, honestly, having a little patience, just waiting for the first 15 minutes to play out, can make all the difference.
So the real takeaway here isn't some secret indicator or magical formula. The edge comes from the consistent, disciplined execution of a well-researched process, day in and day out. It's about weighing the evidence, not making wild predictions. So we've laid out the entire framework for finding order in all that pre-market chaos. You now have the checklist, you have the hierarchy of signals, and you have the strategic blueprints. The only question left is a personal one for you. You have the framework, but do you have the discipline to actually apply it?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.